So you look like a professor.
Do I look like a professor? Okay.
Yeah.
Right, boys and girls, what we're going to do today is I've got one of my colleagues who wants a reminder in how to do, he knows it, but he just wants me to remind him a little bit about how to do DCF calculations, discounted cash flow calculations, in order to value a business. I've got Excel open. I'm going to take a snapshot of this and overlay it over the film a little bit so you can see what's going on, or what the final version of it looks like. But let's just start on one column and write in the figure in which you can normally do DCF from. If you've got a full how to do camera so I can scratch my nose a bit. If you've got a full business model which actually devolves right down to cash, to the actual cash coming in and going out, okay, which means that you've got to have a profit and loss account, a balance sheet, and a cash flow, okay, and this should account for the lags between, the income streams going in and going out, and especially if you're doing it on something like a monthly basis, you should have and you want to do it very precisely, you should have the lags in there and have a cash flow statement at the end, which actually shows you month by month. Especially in cases where the interest rates are going to be high, okay, you need to have it done, more carefully, and do it month by month, and actually account for the lags of payment coming in, and especially VAT as well. Americans don't have VAT, but most of the world has VAT, and that usually creates a bit of a lag in many systems for when you get your money back from the tax office and how you do it. But for the simplified version, what people tend to do is that all they've got is a simple profit and loss account. And that's all they've got. They haven't taken it to balance sheet and cash flow. They will take usually the line, okay, which is EBITDA, okay, and then they'll adjust that for capex, okay, and EBITDA is earnings before interest and tax, depreciation and amortization. Now, for those of you listening in Poland, the difference between depreciation and amortization in the English language is that depreciation is tangible fixed assets, amortization is intangible fixed assets. In Polish, it depends on whether it's in the balance sheet or the profit and loss account, and they both apply equally to intangible and tangible assets. That is simply a false friend between languages. Okay, but in English, depreciation, doesn't matter whether it's in the balance sheet or the profit and loss account, is tangible, amortization is intangible fixed assets. So, you assume that you've got a business plan where you can get the EBITDA figure and you can get the capex figure. Now, as well as the capex figure showing you the capital expenditure, the money which you're putting into tangible and intangible fixed assets, you also need to consider any reversal of that, any money coming back from the scrapping of or the reselling of tangible and intangible fixed assets in that capex line. So you've got the two lines, the EBITDA line and the capex line, including the reversals, and you add those together, you get something called FCF, which is free cash flows. Of course, it's not really cash flows, but if you're doing it on an annual basis, if you're doing a very broad brush simplified affair like most people do, then that's considered to be an adequate approximation for the purposes of valuing a business. So let's imagine now that we've got a business plan from a client. Okay, client, I don't know what you could call it, maybe Urine Samples, EU Rhine Samples Limited. So people think I'm taking the piss if I say that, but let's imagine that you've got that company and it's given you its business plan, and let's write in now, for example, let's imagine that you've got a 2009 business plan. Let's imagine that we're at the beginning of 2009, so I put in 2010. We can just simply go over those 2 years and then run it forward. Usually you'll get about 5 years.
You start with the historic last year, or you just go
on? Well, no, you don't. What you need is an opening position. You don't. What you need is an opening position, and that opening position's got to be the opening position of cash. Okay, because if you're doing discounted cash flow, then you're assuming everything comes back to cash in the end. So I don't want to put the opening position. in well, yeah, I mean, we have to put it here in I've started in column C 2009, 2000 and B, 2009 beginning. I'm going to put in B, yes. So I'm going to call that the OB for opening balance. Okay. So what we've got here in B is OB for opening balance. That only really affects opening cash if we're going to do a DCF valuation. All right. All the other things are not necessarily okay. In as much as you might have debtors there which are expected to come into cash and which aren't in the rest of the thing going forward, because you've only got sales in the 2009, you've got sales of 2009, you've got debtors still in the opening balance that might turn into cash. You might have to pay them off to creditors. They might take the net position of debtors and creditors as well and see how that's going to turn into cash plus the cash you've got in the bank. That would also be a fair way of taking the opening position, but it's cash and what we have at the beginning, which isn't going to be counted again later, which we're sure we can turn into cash. Okay, so that would be the opening position. So let's imagine that you've got that here we've got the cash and cash equivalents and things which you can turn into cash at the beginning. Let's do it in euro. Let's say that we've got 100,000 euro at the beginning position. Now opening balance, I'm going to write here a line saying time, okay, and opening balance, the opening position right now at the beginning, the 1st of January, this isn't the 1st of January, but imagine it was the 1st of January 2009, that's called, for the purposes of investment, what do you call it, evaluation or anything concerning DCF, the time value of money, any time and money calculations, we call that by convention, we call that time naught. Okay, so in 2009 we've got time 1 because we're going to do this on an annual basis. If we were going to do it on a quarterly basis, then you'd call the end of the first quarter time 1, but you'd be adjusting down the everything else to that, so you'd have quarterly interest rates coming in later rather than annual interest rates. The same if you're doing it monthly, which is very precise. I like to do that sometimes just for the sake of it, of course you can be sure that everything in the future is guesswork, yeah. But the more you in any future business plan, the more you kind of get down to the individual drivers and then find out what drives the drivers and put it really down over the month, and you look at seasonality and things like that, the more you're going to find that if you get one thing wrong, okay, one thing goes up, that the other thing goes down, and they tend to net off a bit, and you can actually get quite good models which turn out to show the future more accurately than you think, as long as you put the right kind of logic and get the relationships between things properly. Basically, I'm talking about the time, the way that we call times, and if you're doing it in years, then the second year will be obviously number 2, then the third year 2011, in this case year 3, 4, and 5. Okay, you can use the drag and drop facility in Excel, or the drag facility in Excel to make that quicker. I just want to format the cell in which I've got the money here. So format cells. Oh, it seems to have frozen on me, I don't know why. Format cells, number. Probably it's bulking at the fact that I've got the film going at the same time as Excel. Let's see what else I've got there. I could probably turn off that thing. So speed the whole thing up a bit. I might turn off the mail program as well, because that's usually a bit hungry. Okay, that's more like it. So number, I want to use the thousand separator and take away the decimal places, so we've got numbers showing up. Okay, you should always write down what currency you're working in, so remember to write at the top EUR unless otherwise stated. I always do that, and it always irritates me if people don't use the right ISO currency determinators. If people use the wrong abbreviations that are not in the International Standards Organization, it gets on my nerves, and I think it gets on the nerves of other people too. I don't think I'm the only one that gets irritated by that. So if people aren't sure what it is, and they need to check it out. Okay, so cash. Okay, cash at start, I'll call that to make it clear that it's only used for that particular line. I'll make a little bit broader here, and okay, that never comes again. In fact, I might even just make that, just to show that it never comes again, I'm just going to put some grey colouring in there just to show that you wouldn't expect to have that coming up again. unless of course people are going to make some kind of injections or something else like
Or
that
can
coming
make
in.
cash at the end of the period, maybe? And then it will
No,
show
that's not necessary, because we're assuming that the FCFs are always running into cash. Okay, I'll show you how that all comes together in a minute. Okay, then we take the EBITDA figure, which you'll get off the business plan. Okay, now you don't take that for the opening balance. Okay, you don't need that for the opening balance. So you've got EBITDA coming in. Let's say first year, we might say that that's 200,000 in this particular project. Okay, that the third year, pardon me, the second year. Okay, let's do it slightly differently. Let's make the first year a loss-making year. Okay, so I've got a loss of 100,000. Okay, let's say that we've got, and let me just format that number over the whole thing that I'm going to do, so that I don't have to keep doing it. I've format painted that number into the whole thing, which means I've got to redo that shading there. Okay, so EBITDA, let's have the first year with a negative. Okay, a slight getting into profit in the second year of 20,000. Let's get nicely into profit in the third year of 200,000. Let's take 300,000 in that year, and let's take in the fifth year 350,000. As a business matures, the extent to which it's going to be really building year on year is going to obviously start to go down as it reaches its maturity. You're only really moving up with inflation and how much it can compete against other market players doing exactly the same thing, and it's not going to be remarkably large, the increase year on year. That's a sign of a more maturing business. If we don't get to that point by the end of 5 years, well, then that's a sign that we ought to be looking at a business plan for longer than 5 years. Okay, where if it's not tapering off by that time, then you know the chances are that 5 years isn't adequate to do this kind of assessment on. Now let's look at the capex. Okay, I'm not going to assume any reversals in this, because basically it's simpler to do it that way. But let's imagine that now we have to consider capex is going to be an outflow. Outflows are always minus, just like losses. Okay, so the capex is going to have minus, let's say 50,000 at the beginning for the things which we need to buy, and let's say that in year 4 we need to top that up with another 30,000, so it's another minus 30,000 in year 4. Okay, so here we have a situation where we've got 3 types of figures: cash at start, EBITDA, and capex. Okay, we now can get from that to FCF, free cash flows. Okay, and we add those 3 figures together. Okay, so I'm going to get the sum function here, which is this Greek sigma, and it's gone sum B4 to B7, and I'm just going to, I'll put the borders around that show it's a sum. Okay, top and bottom border from the borders, and then pull it along like this to the end. That gives you, which is interesting,
Yeah, you added just one. You didn't have to add the first row.
so I did. It's added time as well. So I'll adjust that B5 to B7. I didn't notice that going through. So B5 to B7. It's always wise to check yourself, to look at every stage. Don't think that you can't make mistakes, silly mistakes like that. And the mistakes are always silly, so it's a good thing.
I have a question.
Go ahead.
Don't you take into consideration additional amount of cash that you could have as a balance between receivables and liabilities?
We'll assume that that's in the beginning here, the cash at the start, yeah?
But then the results, I mean, will alter during the years, right? So that will be additional cash or less?
Yeah, but it's all in there. It's all in EBITDA. It's all in there. Profit, here, okay. Yes, the idea is that profit will always filter through into a cash position in the end. It's not very precise. Okay? But if you measure your profit properly and you make adequate write-offs for things which aren't going to turn into cash, then EBITDA should be, in the end, it should be a reasonable approximation done in a very broad brush way like this, it's a reasonable approximation. It's a standardized approximation to cash flow, as long as you bring in the capex line as well. Okay, so that gives you FCF here, free cash flows. So you've got the 100,000 at the start, you've got minus 150 in the second year, then we're going up like this: 20,000, 200,000, 270,000, 350,000 over the next 5 years into the future, according to these forecasts. So now what we need to do is we need to start to apply to those free cash flows a discount factor. So you get from FCF to DCF, from free cash flow to discounted cash flow. Okay, now this is where I don't want to screw up because I'm doing this live, and I'd rather do it in one cut than have to redo it again. But what's useful to do is over at the side here, say have a changeable, something which you can edit there, discount factor. So here we're going to have what we're going to have is
it the same as the cost of the credit?
Cost of capital, yeah, cost of capital. Yeah, going to assume cost of capital. That's the good way of putting it. Cost of capital. Now, cost of capital is based on the risk-free amount of capital, which is what government bonds would be, plus an amount for the beta, which is the risk of this enterprise. Okay, but it's also going to be that in certain cases, people's cost of capital is going to come from their particular situation. Okay,
like a particular loan from a bank at a certain rate of interest.
Yeah, right? Well, there you can. At that case, you can look and ask the bank what their required rate is. If we're talking about bank loans, or if it's simply if you're assessing something which is a project, because it doesn't have to be a company, it can be a project. Okay, anything which you can account for in management accounting, not even necessarily by statutory accounting, but anything which you can account for in management accounting as basically a separate entity which you can see the money going into and coming out of. Okay, so if you're looking at doing it within a company, then you might, for example, use ideas like opportunity cost to work out what the cost of capital is. Yeah, it's going to depend a lot on the context of who's making this investment, who's going to finance the investment, and what their profile is with regard to their opinion of the risk of it. Okay, and their opinion related to whether what else they could do with the money. So a lot of things feed into cost of capital. To talk about them would be a completely separate lesson, which I don't want to do right now because it's going to take it too far for people in one go. But you can read about risk-free rate and beta if you want to on Wikipedia. So cost of capital. Let's just leave that here. K4 is a little cell. I'll put a little frame around it there so that people can write in there the cost of capital. And what you can do is you can, if you're making this for a user that you're afraid will mess it all up, you can lock the rest of the sheet and just have that particular thing unlocked. Yeah, by using format cells, there's a position there, and then lock the sheet using using tools. I'm not quite sure exactly where it is on this new version of Excel, but I know it, but it's just finding it again up in this much more advanced toolbar that they've got in this in 2007's Excel. Anyway, cost of capital. Let's just assume we're going to be dealing with 15%. Okay, so if we write in 15%, that's the same as writing 0.15. Okay. Now, as relates to discount factors, okay, you write in this, okay, so the discount factor, and remember, because we're dealing with years, then the 15% per annum, yeah, that's what you put in cost of capital. If you had been doing this in quarters, you'd have to adjust that down for quarters. If you're doing it in months, likewise to months, okay. And then you're dealing. Then the rest of it becomes the same. You make the adjustment here on K4 if you're doing it in other periods than annual. Okay. So it's a mistake and would come up with immediately, obviously, the wrong answer if you're also got your brain switched on and you know what to expect, if you were to mismatch that to the periods that you've chosen to use here on the left hand side there. So discount factor, okay, you do this, you do 1, okay, divided by, and let me make sure that I get the brackets in the right place, so you have to open brackets, okay, and then probably you have to open bracket again. If this is not right, then I'll change it in a second, okay. 1 plus, okay, K4, okay, I didn't put the equals at the beginning, which is why it's not behaving normally, it's treating it as text, equals 1 divided by, open brackets, 1 plus K4, close brackets. That is what we then take to, that's what we take to the power, okay, the power here. Now notice, okay, we're going to be pulling that along horizontally there, so we want to make sure that B is free. 4, just in case we decide to do anywhere else, is supposed to be addressed absolutely, and therefore we place the $ before the 4. For the K4, because it's something which we don't want to move, we place the $ before the K and the 4. Okay? Oh, that's because I didn't. Okay, I want to. So I need to put the parenthesis there. Okay, and that should work. That should work. Before I click the enter, let me tell you that when I do that and then drag it across, anything raised to the power 1 is 1, and 1 divided by 1 is also 1. So the answer will be 1 if I've got it right here. Okay. The answer will be about, well, the answer will be the same as 1 divided by, well, 1 divided by 1.15, effectively. Let me turn the calculator on. It's good if you've got a calculator by the side, then you can check whether you're getting things right. 1 divided by 1.15 is 0.869. So that's what should be then in position 1. If those two are right, then I know that all the rest will be right. Okay? So, and then effectively what happens then is going to be, the second period will be the square of that figure anyway. Okay? So it's so 86.9% divided by that's going to be something like down in the 70s for the second time. Okay, so I'll click enter. Yeah, 1. Let me add some using this arrow with the. Let me add 3 significant digits after the point, or in this case, because I'm using continental version, the comma. Okay, and then pull it along. Okay, and yes. You see, the amount that I predicted has appeared in C1. Okay, exactly. So this is a useful way to, this is just showing how people should check themselves, especially if they're not doing this on a day-to-day basis, but doing it every so often, and could, if they're not careful, make a mistake. So, and now what it happens is that if you then adjust the cost of capital, then you can basically immediately see the difference. Okay, so now we've got a discount factor. Okay, and then you take the discount factor and you multiply your FCF by the discount factor. So and that gives you the DCF. Okay, so free cash flow times discount factor equals discounted cash flow. Right. So that means plus the B8 column multiplied by the B10 column gives you 100,000. Obviously that's predictable, and you can pull that along. You can put a frame around it so that you can see that that's the DCF. And then what you need to do is you need to there's a stage which I've not remembered to apply to this. Okay, that is that we assume this is something called the Gordon-Shapiro formula. All right. It's the annuity at the end of a business. You're not obviously assuming that things are the same going forward into the future. And let's say that, okay, that we've agreed an assumption that by the year 5, that 350,000 going forward is going to be stable. So you've got 350,000 going forward. Okay, I'll write that in. let's assume also that, okay, there will be recurring capex, but let's assume that increases in that 350,000 in the future will also cover the capex, and that effectively the free cash flow into the future will also be. So we're going to call that GS at the end, which is Gordon-Shapiro. Okay, and what we do with this is that we assume, okay, that this divided by the cost of capital, okay, is the annuity, or the value of that annuity. So therefore we say annuity value at the end, okay, and remember we're doing all this in column H, and that is also assumed to be time 5, because that's the end, that's the opening balance of time 6 is time 5. Okay, so I put time 5 in the number 4 line, okay, and then what we can do is we can use we put the annuity value in here. All right, let's put it in the FCF line, that'll make it even easier. Okay, but first let me do this. Let me take equals the EBITDA of, actually let's do it differently. Let's do it slightly differently. Let's take the FCF line, okay, let's apply that, then divide it by the cost of capital from K4, okay. That shows you that we believe that this will provide us an annuity that will pay 350,000 per year indefinitely at a cost of capital of 15%. That's equivalent of it being worth 2.3 million, okay? But it's worth that in 5 years' time, and therefore we also need to discount that, okay? So this, we take it forward, it's still the same, as you see, the same discount factor as it was for 2013, because we're talking about the end of 2013, okay? So what we then do is we can then go, for this figure here, we go equals the annuity value times the discount factor. So it's, instead of being worth all that money, it's worth only half of it, because we're talking about that value, but in 5 years' time, worth less than today. Yeah. So so here we are, or worth less than that today. So there we are with that. That's all the elements you got. Then all you need to do is add them up. Okay. So the value of the business, according to that, okay, is the sum of, okay, I'll use the S again and then draw it across all of those things there. That gives us a value of the business of 1.9 million euros in plus. Okay, now that's how to value a business given the cost of capital. What people can also ask is, well, what's the internal rate of return? At what value will this business not be worth anything? Yeah. Just save
Say it
this.
again. At what value?
What value cost of capital will this business not be worth anything? Sorry, I started speaking gibberish because that's doing too many things at once. At what value of cost of capital will this business cease to have a positive future expected value on a DCF calculation? So that's DCF Lesson. I'll stick it in documents. Okay. So therefore we need to do something with that, okay? And when you put it in Excel like this, you can use the trial and error approach. You can remember that, okay, 15% gave us 1604656 in plus, and I'm going to leave it this way. When I put the image onto the film, it's going to look like it does here, okay? Other than the fact that I'm going to squeeze that in a little bit more, but maybe put that there just to make this ability to get it in a little bit more like a screen shape. But basically, what you do then, okay, we've left it at 15% as far as the photo of this is concerned. All right, and I'm just going to go. Well, I won't do that now. I'll do it afterwards. But just to show how to get to, you take K4, okay, and you start to muck about with it. Now, if at 15%, which is a fairly high cost of capital, even now hasn't always been high. There's been times recently when that would have been extraordinarily high. But for a risky business, especially a new startup, you might find 15% is quite common, so therefore, at this case, it's a good investment. Okay. Whereas let's start to take it up a bit. Let's say that we change that to 25%. Will the business still be profitable? Well, it's only half as profitable at 25%. Okay. Will it be how profitable it will be at 35%? Well, it becomes even less profitable, but it's still holding up extremely well to that whole model. One of the reasons why it's very difficult is because of the fact that, okay, the cost of capital is being assumed to be also applied to the annuity value. The same cost of capital here is bumping up the value of the business at the end here as it is there. But of course, it's then affecting pulling it right back down again on the discount factor. Let's make it 45. Well, at 45 we got it right down to there. I mean, will it still have even at 100%, will it still pay? Well, yes, it's still positive at that, so it's a no-brainer, yeah. Which actually in itself would mean that people would probably be a little sceptical about this business model because it looks too good to be true. Let's, for the sake of getting to a DCF, okay, change down. I'll change them back up again at the end so that it looks like I said it would look like. Let's change these down to only 250,000 and let's make this one here only 100,000 and let's make the opening cash only 10,000. Okay, at this point we've now got a negative value of the business here. Okay, if I put the capex in the third period to 300,000, well then we've got a seriously negative here. And just to show you going back, then you can adjust the cost of capital going backwards like this until this becomes zero. When this becomes zero, the value of business becomes zero. At the moment I've got 30 minus 31,875. Okay. When that becomes zero, okay, that's the internal rate of return. So at 100% it's negative. At 70% it's only slightly negative. Okay, I'm pulling it down now to 65%. That's positive. Okay, 66%. Slightly negative, so 65.3%, something like that. 65.3% is going to be. Oh, hang on, I didn't use the right point. This one, this continental version needs me to use the comma. 65.3%. That gives you, yeah, only a value of only minus 6. So you could say that 65.3%. Is pretty much the internal rate of return on the project as it was after I did those adjustments to it. Yeah, I'll take a photo of it at that stage as well, at the end of it where I've got an IRR. So this becomes the internal rate of return. I'll take a photo of that as well at the end and put that up at the end. Fantastic. Is that, you reckon you'll be able to? I'll send you this. Sure. And then you'll be able to use the same principles when you get this in a couple of days, that business plan from the client, the real client that we're not going to mention, okay, in a couple of days, and you want to run a DCF on it, you'll be able to use these principles to run it, and then I'll check it, okay? Right. Okay. Okay.
Yeah, only the last part is called Shapiro formula. It sounds a little bit strange to me.
Well, yes, it's a big assumption, and a lot of
Can you
people.
reword it? Like, what is the usage of that? What does it show?
Well, it shows you that the business doesn't just stop after 5 years. It shows you that the assumption is going to carry on forever.
Mm-hmm.
Now, some lenders won't like that too much. And anyway, you must be sure that the value of the business, once it's done this way, okay, it doesn't mean to say that somebody's going to come along and give you what comes out of this for the business, okay? Because at the end of the day, you can be sure that if somebody's buying a business which has got all sorts of things, risks that things that they've done in the past might come out, they're going to want to have a nice discount on whatever comes out here, because that's what, if they're lucky, they'll get out of the business.
Sure.
Why just pay that? Yeah, why not just keep their money? Yeah, why bother? Yeah, so you're never going to get paid what comes out here for your business. That's going to be, you're going to say this is what it's worth in DCF terms, but a buyer's going to want a discount off that, and that's where he makes his profit. So you can't just go along and say, hey, that's what I'm worth. That's what, because my business is worth this much on the stock exchange. Yes, you might get it. You might even get more if there's a lack of, if there's more money on the exchange than there is. These days, of course, it's less. Yeah, the market caps of businesses are not as high as you would actually find if you ran their calculations like this. Probably, it will all come back later on. But basically, the two should be linked together in some way, because there's this assumption that the capital markets know everything that's going to happen in the future. Yeah, that's the efficient markets hypothesis, is what it's called. It's just a hypothesis. But actually, they're not very logical and they're not very rational. Basically, what in private business, okay, if you float on the stock exchange, you might get something more like this for the business. But in private business, when you sell a business to somebody else, then you won't get what comes out of this. Yeah, that's going to be what you're going to argue that the business is worth this, and I'm letting you. And if you offer me this, well, then basically all of this is your profit, and let's be a little bit more fair about this. It may well be that you get half of what comes out of here. Yeah, and again, a lot of it will come down to the fact that the buyer is going to say, hey, you need money now, so I'm not going to give you a very good deal on it. Yes, okay, I accept that your DCF calculation is correct, but I'm not going to give you the whole thing. Yeah, I'm only going to give you a ridiculously small fee because I know you need the money. Even though I accept everything in your DCF calculation, which is pretty much what we did to somebody a few months back, isn't it? And they didn't accept the squeeze that we put on them, which is fair enough. They might not accept it. Everybody's free to offer and to accept or reject an offer. Nobody's
expects his price.
Yeah, well, that's right. He rejected the offer, but he still hasn't sold his business. But basically, what we're now going to use this for in a couple of days, and I'm not going to give any details as to even the sector that it's in, but it's going to be applied to several units of a business which is going its own way. The two shareholders are going their own way, and it's going to be applied to several units so that they can see what the parity is, who gets, if this person takes this unit, and this unit, okay, is he getting a fair share if this person takes this unit, and this unit, and therefore, because we're going to apply the same procedure to all the different units, is going to ensure a fair distribution. Okay, as long as exactly the same procedures are done on all the three, and in order to make sure that they're fair, we're not only going to base on DCF. We're going to base on DCF. We're going to have a higher weighted average coming out of the DCF. But we're also going to use the other two methods as well.
You're going to treat the general total results of the whole company, not a particular.
No, this is going to have to be done. This is going to have to be done on the whole, on each location as well as the total. Okay, yes. We had that. I don't want to go into details because I might breach confidentiality. But we had a number of units, and we also had some land as a separate unit, which won't come up on DCF at all unless instead of that we place a surveyor's valuation in that place.
Data for each particular location. That's
well, we have to have, otherwise we won't be able to achieve what that guy expects of us.
But we can value the value of the whole company, and then I presume that if it's divided in a
No, that
fair
wouldn't
way.
work. You have to get these. I mean, this was what was said in that meeting that I was part of. I didn't go down there, but in the meeting that I was part of, I was told that we were going to get this detail for each of the individual things. I asked that question specifically. So if we haven't got that, we have to raise the flag immediately.
I see. Okay. Yeah, I see your point.
Yeah, because that was the whole purpose of it.
I'm just not sure what kind of data we have at the moment.
Well, if we haven't got that, if we've only got the total data for all 6 places, okay, then
No, we do have particular data. Yes, we do. We do.
well, then that's all right. Then that's what we should have. Otherwise, it wouldn't have worked. You see.
Even though there are some general costs that have to be allocated to, like the board or the management.
Okay, well we'll allocate them to the. But have we got EBITDA? Or are we on the way to EBITDA after we've allocated them? I can allocate them and get to an EBITDA. That's not a problem. We'll find some basis. We can allocate it on the basis of other costs. But as long as we do the same thing to all of the units and follow exactly the same procedures, then we can share that business out amongst the 2 shareholders fairly. Okay, and that's the important thing. We can't just use DCF for this. Okay, but DCF is certainly the most scientific way of doing it, and so of the various valuation methods, we're going to give a higher weighting to the DCF method than to adjustment to fair value of balance sheets, which is another method, and the straight, the straight, peer review way of doing it. But this is the way of doing it, which is most scientific.
Right.
So we will be able to do it okay that way, as long as we've got like. Oh, where is that? Oh yeah, okay, that's this one. You've got all of the. You've got all units.
I can't see any to here.
No, that's perfect. That's perfect. Actually, you could do that. If this data has been checked, then we could almost do it based on that. To be honest with you, have you got the capex figures too?
No.
Oh, well, that's what you need. Okay. So that was the lesson for my colleague, just to refresh him. He knew this already. You remember all of that. You were asking about the GS, the Gordon-Shapiro, yeah? Well, the Gordon-Shapiro is about the annuity. That's what the company's worth at the end. So it's like thinking about your pension. Yeah, you can think what your pension's worth, what it's going to be worth. If you had to purchase an annuity at the end from your pension plan, that would be the annuity, the value of that annuity that would pay you out so much per year. But then you have to also think about the fact that I'm only going to get that annuity in 5 years' time, and so I also have to then discount that back over the discount factor, which applies in 5 years' time or 10 years' time, however many years you've actually put in the main part of the plan. Right, okay. I hope that wasn't too much gibberish for people, and that people that want to know how to do DCF have had some help from it. But if after all of that you still want to have somebody else do your DCF for you, then you need to contact me through the email facility on YouTube. Thank you.